Everyone is talking about how high silver can go. Curious. Nobody is asking the question that actually protects your money right now. How low can it go? Because here is the truth that most silver content creators will not say on camera. Whispers. Silver is currently sitting in one of the most dangerous technical positions of the entire 2026 bull run. The charts are not lying, and if you do not understand what they are showing right now, you could watch months of gains disappear before you even realize what happened. Exhales sharply. I am going to show you the exact price levels, the exact signals, and the exact scenario that sends silver significantly lower from here. Not because I am bearish on silver, but because the investors who survive volatile markets are the ones who understand both sides of the trade. This is RateScope, logic, not hype. Let me start with where we are right now, because the context matters enormously. Silver touched an all-time high of $120 per ounce back in January 2026. That was after an absolutely historic 2025 where the metal gained nearly 150% in a single year. 150%. That is the strongest annual performance silver has recorded since the late 1970s. Now silver is trading in the low 80s. So the first question every serious investor needs to answer is this. Is this just a healthy pullback inside a bull market? Or is this the beginning of something much more painful? The charts are giving us a very specific answer, and it is not the answer most people want to hear. Here is what the technical picture actually looks like right now. After that peak at $120, silver has broken through multiple support levels on its way down. The first major line of defense was around $93. Gone. The next was $88. Gone. Silver is now testing what analysts are calling the most critical support zone of the entire year, $80 to $84. This is not just a random number on a chart. This zone represents where the major institutional price targets for 2026 are clustered. It is the floor that the big money penciled in at the start of the year as their base case average, and right now, silver is sitting right on top of it. Here is why that matters so much. When price sits on top of a major institutional support zone, one of two things happens. Either the buyers who have been waiting step in aggressively, absorb the selling, and launch a recovery, or the support breaks. And when major support breaks, it does not just become neutral territory. It flips to resistance, which means the next time silver tries to climb back above $80, it will face sellers who are now trapped from higher prices and are desperate to get out even. That is how corrections become something worse. Now let me show you the specific levels that analysts are watching on the downside, because this is the part of the story nobody on YouTube is mapping out for you. If silver loses the $80 level on a weekly close, the first target to the downside is $73 to $76. Why that zone? Because that is where the most recent breakout rally began, before silver surged toward 120. Markets have a memory. Breakout zones become support zones on the way back down. But here is where it gets uncomfortable. If 73 to 76 does not hold, the next major support sits at $69 to $70. That is the level that multiple technical analysts, including teams at investing.com, have flagged as the deeper support structure for 2026. A move to $70 from current prices around $82 would represent roughly a 15% additional decline from here, on top of the drop that has already happened. And if $69 to $70 breaks, you start hearing analysts talk about $60. At $60, you would be looking at a 50% total decline from the all-time high. Now, before you panic, let me be very clear. This is not the base case. This is the worst-case scenario that analysts are stress testing. But the fact that serious institutional analysts are running this scenario at all tells you something important. This is not a market where you can afford to be careless. So what would actually cause silver to fall that far? There are three specific headwinds that the charts are warning about right now. Headwind number one, the dollar is getting stronger at exactly the wrong time. The US dollar index just hit a multi-month high. Every time the dollar strengthens significantly, silver faces mechanical selling pressure. Why? Because silver is priced in dollars globally. A stronger dollar means every foreign buyer is effectively paying more for silver in their own currency. That kills demand at the margin, and right now the dollar is getting a boost from something very specific. The nomination of Kevin Warsh as the new Federal Reserve Chair. Warsh is known as an inflation hawk. Markets are now pricing in a scenario where rate cuts that were expected in mid-2026 get pushed back to late 2026 or eliminated entirely. Higher for longer interest rates, stronger dollar, more pressure on silver. That is the macro headwind sitting directly in front of this metal right now. Headwind number two, the RSI and momentum indicators are broken. For investors who are not familiar with technical analysis, the RSI is a tool that measures whether an asset is being bought aggressively or sold aggressively. When silver was surging from $65 to $120, the RSI was showing extreme buying pressure. Now it is showing something very different. The momentum has flipped. Technical analysts are pointing to what is called a change of character on the charts. That is the technical term for when a market that was making higher highs and higher lows suddenly starts making lower highs and lower lows. Silver just made a lower high. It just made a lower low. That is not a healthy correction signal. That is the market telling you the short-term trend has changed direction. Until silver reclaims specific levels on the upside that I will get to in a moment, the technical picture favors more downside before any sustainable recovery. Headwind number 3, the overbought hangover. This is the headwind that most people completely ignore, and it is probably the most important one. Silver gained 150% in 2025. 150%. In markets, moves of that scale always leave a hangover. Not because the asset is bad, not because the fundamentals changed, but because of something very simple. Too many people bought at too many different prices on the way up, and not all of them have the conviction to hold through a serious correction. When silver was at $120, there were investors who bought at 110, at 100, at 95, at 90, and at 85. Every single one of those buyers is now sitting on a loss. And as price comes back down through each of those levels, some percentage of those investors decide their pain threshold has been reached and they sell. That creates a wall of trapped sellers above the current price. It is called overhead supply, and it is one of the biggest technical headwinds silver faces right now. The chart is not just fighting bulls and bears. It is fighting an entire year of buyers who are looking for any rally to reduce their losses. Now here is the side of the story that prevents this from becoming a catastrophe, because the headwinds are real, but so is the foundation underneath this market. The supply deficit. The Silver Institute has confirmed that 2025 marked the 5th consecutive year where global silver demand exceeded mine supply. 5 years in a row. The cumulative shortfall since 2021 has now climbed above 820 million ounces. Let me put that number in perspective. That is roughly equal to an entire year of global silver mining output. Gone. Consumed. Not sitting in a vault somewhere. And the structural demand that is consuming silver is not going away. Solar panel installations hit a global record in 2025 and are accelerating in 2026. Each new generation of AI data center servers uses 3.5 times more silver than traditional hardware. Electric vehicle production continues to grow, and EVs require significantly more silver per unit than conventional vehicles. Mine supply is essentially flat at around 813 million ounces annually. New large-scale mining projects take 7 to 15 years to develop and come online. There is no supply relief coming in the next 12 to 24 months. Bank of America's metals research team has one of the most aggressive targets on Wall Street. They see silver reaching anywhere between $135 and $309 per ounce before the end of 2026. That wide range is intentional. The lower end assumes a natural bull market continuation. The upper end assumes a physical delivery squeeze, the kind of event where paper markets cannot keep up with demand for real physical metal. Neither scenario requires a miracle. Both scenarios require time. So what does this all mean practically? Here is the decision framework that serious analysts are using right now. Watch $80 on the weekly close. That is the line. A weekly close above $80 means the bull trend is damaged but alive. Dips into the high 70s and low 80s are accumulation zones for patient long-term capital. A decisive weekly close below $80 changes the entire picture. In that scenario, 73 to 76 becomes the next target, and you do not want to be adding aggressively until price finds footing and starts making higher lows again. On the upside, the level that confirms the recovery is $87 to $88. That is where overhead supply from trapped sellers gets worked through. A daily close back above 88 signals that the correction is over and the next leg higher is beginning. Above that, the $91 level is the confirmation that the bull is fully back in control. And above 91, there is very little standing between silver and a retest of the $100 psychological level. The game is not complicated. The game is patient. Watch 80 on the weekly close. Watch 88 on the daily close for the all-clear signal. Do not add aggressively until you see one of those two confirmations. Let me leave you with the honest summary. Silver is facing real headwinds right now. The charts are showing a broken short-term trend, overhead supply from trapped buyers, a stronger dollar, and the possibility of higher for longer interest rates. The worst-case scenario has silver testing $69 to $70 before this correction is finished. The base case has silver holding the 80 to 84 support zone and building a base for the next move higher. The structural case, the 5-year supply deficit, the solar demand, the AI infrastructure build, the drained COMEX inventories, that has not changed at all. The price on your screen is not the same thing as the value of the metal, and right now there is a significant gap between the two. The investors who understand that gap and position accordingly are the ones who will look back on this period as the best buying opportunity of 2026. The investors who chase prices higher or panic sell lower are the ones who fund those gains for everyone else. Know your levels. Respect the chart. Trust the fundamentals. That is how you survive a market like this. If this breakdown gave you something that other channels did not, hit subscribe. RateScope covers silver, gold, rates, and macro every week with no hype and no agenda. Drop your questions below. I read every comment. Stay sharp, stay stacking.